Hello, everybody, and welcome. I'm Bonnie Halper. I write the weekly Startup One Stop newsletter. I'll put the link in the chat. And every 2 weeks, we host an online investor insights with one investor and a self-selecting group of entrepreneurs so that it really is meaningful, that people can ask questions and get their questions answered. I also work with founders. I help them with their pitch deck. I write their pitch decks and their executive summaries and make introductions to investors and strategics where and when appropriate. Then I want to thank Joseph for hosting us. I'll put my email address in the chat too. Thank you for hosting us, Joseph. Joseph, tell us about yourself.
Thank you, Bonnie. Thank you, everyone, for joining and for adjusting on the time schedule. My name is Joseph Katz. I'm a bit of a startup marketing guy. I've been in the space for a long time. Results-driven marketer. I've seen the good, the bad, and the ugly of growth marketing, and so happy to chat with anyone about their marketing needs, go-to-marketing plans, and so forth. I'll put information into the chat, and everyone should feel free to do the same. I'll also include a link to all of our recordings of these events from the past. So thanks for joining and looking forward to a fun conversation today.
And today we have Drew Aldrich from Viewpoint Ventures. It's a fund with a very specific viewpoint. Now, Drew, I don't know if you want to. Here's your friend Andy. Andy Harrison introduced Drew. Introduced us originally. Awesome. So I don't know if you want to tell us a bit about yourself and the fund, or you want us to go around the room and have the attendees introduce themselves first. It's up to you.
Actually, yeah, I would love to know who's in the room. So maybe do sort of really fast name, location, and what part of the startup ecosystem you're in.
Take it away, Janice.
Okay, well, I love the time as a West Coaster from Portland, Oregon. I'm happy to be here. I have a consumer goods product, so it's not tech, but I'm opening up the travel goods industry. My product is a head, neck, back support system called Tausi Brands, and it is a non-pharmaceutical intervention. We are started out in the geriatric and senior space and healthcare. Now, this year, 2024, we're opening up 2 new markets: the travel industry in Q1, and then Q3, the student life industry segment.
Thank you. Amy.
Hi, everyone. I'm Annie, and I am a project manager working at an influencer media agency. And now I also am influencer strategies, basically help the creators find the clients and help each other grow their business through social commerce. So willing to chat if you are interested in social media marketing. Thank you.
Andy, you know, when we used to have the insights in person, Andy was my wingman.
Yeah, you're being too kind. I was sort of like a doorman. Don't embellish. Unlike Ryan, who's a smart guy, I'm the not so smart guy. Andy Harrison, strategy consultant by trade. I'm an LP in 2 early stage VC funds which focus on B2B SaaS. No, I'm not in Drew's fund, but I have known Drew for quite some time. Go Pelicans. And that's my story, and I'm sticking to it.
All right, smart guy.
Oh boy. Good afternoon, everybody. I'm so
pressure's on now.
I know, right? I'm used to saying good morning, but good afternoon, everyone. My name is Ryan Hurd. I'm the founder of Caregiver Smart Solutions, which is AI for aging in place. We are a simple and effective way for caregivers across America and the world to monitor, assist, and ensure the safety of their loved ones that are living on their own. Our mission is to give 1 million families more peace of mind in real time. We're currently focused on B2C and B2B2C. There you go.
You know, I want to share that I found, I learned recently that Ryan is also mayor of his town.
I am. It's been a wonderful, let's see, 32 days. This is now the 1st of February, so it's all good here in New Jersey.
Oh, congratulations.
Thank you.
Great.
Sorry, Sam, even slower out here. See, I'm on California time. Sorry about that, Bonnie.
Oh, I'm sorry, there were 2 Craigs. I forgot.
Oh, I'm sorry. Is there 2 Craigs?
Yes, but Craig.
Craig, you know what? I will always heed Craig Brombard Suri. I'm sure he's interesting and more than interesting to me, so I'll let him jump in first.
No, you can go first. That's fine. Go ahead, please.
Perfect. Well, I will jump in. Andy, again, thank you for your support, Ray. Craig Isaac, I'm out here in Los Angeles. As you see behind me, I've got some of my new AI artwork because it's something of a new hobby and a venture that I'm venturing in on. I've been in specialty banking for about 25 years. Currently, I'm in transition. As it turns out, my bank went through a merger during the holidays. And so I've been exploring new opportunities. So right now, I've been really active on working to be a connector and continuing to see where I can be creative, especially with entrepreneurs like the folks here, as I ready to take on my next spot. So it's great to see everyone and look forward to connecting. Thanks, Bonnie.
Very welcome. Other Craig Bromberg.
Hey there, it's Craig Bromberg. I'm here in New York City in Brooklyn, and I'm the CEO and founder of Homesy. Homesy is a social network for real estate consumers. It's like LinkedIn for your home. Essentially, our objective is to connect people to create new data, last mile data about their home, and to create matches partly through AI, but also through the power and strength of the network effects that users create. And we are just starting because it's been hectic and crazy with fundraising. And so now we're looking to raise funds and do a pilot in a small place like Nashville or Boise or Pittsburgh or Cleveland or someplace like that. And so we're deep in the process, in about 3 years of work and moving it out. Thank you.
Thank you. Ken.
Good morning. Yeah, I'm Ken Deering, CEO of iGuard Home Solutions. We are an InsurTech provider in the business of increasing the profitability of property and casualty insurers and LTC insurers by using our predict and prevent solutions to reduce claims. And we have 2 of the top 10 insurers who will be promoting our products, our second generation products that we're launching in Q2.
Congratulations. Andrea. Oh, you're muted out. She might be multitasking.
Yeah, hi.
Okay.
Hi, everyone. Sorry for the background noise. In my last life was an attorney, but in this one have been working for a family and also close with a few other American families where we try to look at interesting tech opportunities here in the US. Also advise a fund of funds and a couple of companies. Good to be here. Thanks, Bonnie and Joseph.
Yeah. Thank you. Eugene. Names keep jumping around.
Hi, nice to meet you. I guess Ray was on a, is he still here or he lost him?
Here, Eugene. How you doing?
Okay. Yeah, I guess so. One of you were on a angel investment platform presentation with this company Landmark, with some companies presented yesterday. So I'm not sure exactly how I found out about this, but somehow I came across it and figured I'd join and see what's going on. I am working on some startups in the healthcare world. One's a cancer diagnostic out of Johns Hopkins University, and the Mayo Clinic's involved. And another is a surgical training and surgical simulation technology to improve training of surgeons. And I'm an angel investor as well, and very involved in something called the Princeton Alumni Angels.
Oh, okay. Oh, I know those guys. Ian.
Good. Hi, everybody. Good afternoon. Ian Garmez. I'm in Toronto. I am COO of Virtual Film School in LA. We are an online school for prospective influencers, and our curriculum was developed over 15 years at USC. Good to be here.
Oh, thank you. Who else do we have? John.
Thanks, Bonnie. So, John Donovan, CEO, founder of PeerTree. We're in the computer-based collaborative learning space. We do private label learning communities as a service. We work with a wide variety of thought leaders in their industries or sectors, and we use their content to interact with organizations and change behaviors. AIs and machine learning is also involved to sort of assess where organizations are And we work in a broad variety of sectors, from trafficking to healthcare to cybersecurity and others. And we're posing our seed plus. We're determining whether or not we can go with an A or just self-fund with existing clients. So thank you very much.
Joseph.
Hey, thanks. I'm a New Jersey-based investor. I do a little bit of real estate and early stage tech. Just recovering from back surgery and spinal infection. So apologies. Keep the video off.
We're just happy that you could make it. Sarah.
Nice to meet you all. I'm Sarah. I'm a COO and co-founder of ADRO, a financial services platform for international students and immigrants coming to the US. We just raised our pre-seed round of about 2.1 million, but I'm excited to learn about strategies for thinking ahead to our seed and Series A. I'm also an angel investor. I'm excited to meet the group.
Oh, congratulations. So I know it's never hard raising funding. Zeren. Never easy.
Hello, I'm Zeren, based in Switzerland. I have a banking background, and currently I focus on strategic partnerships and business development with a few firms, mainly in e-commerce and asset management area.
And last but not least, Ray.
Hey, thanks.
Ray.
Thanks for hosting, Bonnie. Launching Raycon, launching a platform that can move any digital asset entirely over the internet without using any intermediaries. Thus, we can basically disintermediate Visa and MasterCard and make payments 50 to 70% cheaper for merchants. We can also basically put any video or any experience on a bottle and tap, working with a wine distributor to put that on 10 million bottles. So very cool technology. Thanks for the time.
Oh, thank you all. And Drew, you have the floor.
You haven't asked me yet, Bonnie.
Oh, who did I miss?
Miss Amy.
Amy, I'm sorry.
Go
You know, the
for it,
names
Amy.
keep popping around. Amy, I'm so sorry. I'm so sorry.
No worries. Yeah, so I'm Amy. I'm in the Bay Area currently, but also back and forth between Los Angeles and here. So it's the first time I joined since Joseph invited me a long time ago, because can't get up that early in West Coast. Yeah, so I'm a founder of Dance for Healing. It's an AI-powered telehealth platform that matches buddies for chronic disease patient and elderly, especially intergenerational, to help them build fun, healthy habits, do music, dance, and arts. Myself is a cancer survivor stage 4, and I gone through a whole year isolation, loneliness, stuck at home, and music and dance was the only outlet that I could cope with all the challenges and completely accelerate my recovery and surprise my doctors. And this is why I'm so passionate, bring it accessible to all, for those stuck at home especially. And we are actually currently funded by NIH, so I'm not looking for outside investor immediately. And we are recruiting minority diabetics. We have a couple more NIH funding pending, but maybe next year we were looking into raising an outside round.
Congratulations to you and good on you. Drew, without further ado, I apologize.
Yeah, so anyway, it's great to meet everyone. It's a pretty diverse set of startup people, so that's great. So I'm calling from New York. I spent the last 10 years in insurance and wealth management, venture capital, sort of specifically those industries. I got my start at a large insurance company called AXA.
Yep.
And helped them build their venture capital fund, and then was an investor at their venture capital fund. And so was there for about 5 years. And then I got poached over to a group called American Family Ventures, which is another insurance company owned VC fund. And was there for 5 years and had a great run there. And got lucky in a whole bunch of different ways, which led to a large anchor investor approaching me in 2021 to start a fund. And that's what led to Viewpoint. The Viewpoint, we are a little unusual for VC in a number of ways. And I think I'm going to sort of come back to that point, being that I don't think we are representative of the vast majority of the VCs that some of you guys might be approaching when you go for funding. So you should truly when I give the answers to the questions, I'll answer them honestly as we think, but you should know that Viewpoint is very specific in our approach and our beliefs and our strategy. And so we sort of, I definitely don't speak for the industry writ large. So just the last sort of things about the fund and our strategy. We are a deeply thesis-driven fund. We have a very specific thesis. The way we talk about it now, though you won't see this on our website, is that we love businesses that control distribution in producer-led industries. So producer-led industries are industries with an agent or a broker, human wholesaler, advisor, things like that. And businesses that control distribution. So sort of flip of that is what we don't do. So we actually don't do anything that's direct to consumer. We don't do anything that is a balance sheet business. We don't do anything that's like an underwriting business. So where the core of the business is that startup's ability to assess risk of a population, whether it's insurance or credit. And most controversially, we don't really do SaaS. In our markets, SaaS tends not to work. Effectively, direct to consumer doesn't work. SaaS doesn't work. Most things don't work in these industries, or at least that's what we believe. So anyway, we're very, very narrow, and because we're so narrow, we are. You sort of think about as a fund, our true north is the thesis that we have about what works, or at least what we know that what works, and we have a return profile requirement. After that, everything else is a bit flexible, meaning we have a very, very late stage company that's doing multiple hundreds of millions in revenue. You have a seed stage company. We're only going to do 8 to 12 investments in this fund. We've done closing our 7th. So we're very concentrated. I mean, most VC funds are probably 25 to 40 investments in the fund. And we actually do secondary transactions, meaning we enter into a deal not through a round per se, but sort of buying shares of a founder or an early employee where we think we think the company is particularly special. And then one last note on, again, just to emphasize the point that we're going to sound a little different. Of the 7 investments we've done, 6 were what I'll call off cycle, meaning the company wasn't raising at the time, because the thesis-driven nature allows us to sort of identify a thing that we like, and then we sort of pursue that thing unrelated to whether that company is doing a round or not. So all those things will sort of cause us to have probably slightly different answers than a traditional sort of stage-focused VC fund who's going to do 25 Series A's in their fund. So anyway, that's my quick. And I appreciate everyone being flexible on time. I have a 2.5-year-old and a 5-year-old, and need to take the 5-year-old to the doctor. So I appreciate the change in times.
And that's why we have all these different investors. Everybody has their own viewpoint, and that's what we appreciate. Yes. And they have different answers to questions. Everybody has a unique view. So, does anybody have a question? First question. You always have a question. What's I text you right? I'm just curious.
No, I'm just getting used to this thesis, but
okay, I'm sorry.
What kind of opportunities do you see right now? I mean, do you think there's a kind of like a target-rich environment for your kind of thesis at the moment?
What's interesting is, I mean, we do so few, right? We probably do we do between 1 and 4 deals a year, and that's probably more like 1 to 3. So we're never. I would say it's never target rich. What is helpful? So I'm assuming everybody. The way I view what's like currently happening in the venture capital world is, I mean, we're going through our 2008, 2009 moment right now. I mean, I sort of I'm assuming that a huge chunk of the VC industry will disappear in the next 24, 36 months. VCs are traditionally very, very difficult to kill because we have 10-year life. When we take money, we take it for 10 years. So, you'll have these zombie funds that are sort of going and going and going. Don't project the fact that they're no longer really functionally in business. But the spigot to our own LP capital stopped in at the end of Q4 2021, really Q1 2022. And so there's been very little capital that's come since, and that has then trickled down the rest of the chain. So it started with the LPs, went to the GPs, that's us, then it's gone down to the startups. And so like deal volume is way, way, way down. Well, that's true. It should have been more true in 22. It was really true in 23. In 24, it feels like there's I don't know, like there's like green shoots of sort of optimism that are coming up, which is great. There's a lot of pain that still needs to be recognized, meaning startups that are functionally zombies are going to hit walls in 24. I'm just bringing that up because in 23 there was just not a lot happening. I thought we were going to end the year with one deal. We ended up doing one deal in the middle of the year, but then signed 2 term sheets in December, which are closing the second of those right now. But so yeah, definitely I would not call it a target-rich environment. Where I think for our specific thesis, what tends to be the case is wherever there was a private equity firm rolling up businesses, there's a good chance there's an interesting play for a tech version of that that's sort of that's not yet big. And private equity has been doing roll-ups, lots and lots and lots and lots and lots of roll-ups. And so I feel like in general there's lots of targets or sufficient targets for us, but I would not call it a target-rich environment.
Great. I understand. Thanks.
Andy
Very
posted
long
a
answer.
question in the chat.
Oh, let me pull up the chat.
You want to ask your question, Andy?
I suppose I could, but let's talk about people and team, discuss the importance of team and what you look for when you're looking at the people component of an investment opportunity.
This will
It should be
hit
moment,
again.
it should be opportunity, not moment there, so I apologize for that.
No, in my experience, there's a number of startup founders who I have backed, who traditional VCs would tell you they were not good venture founders. They didn't, they sort of did not have traditional GSB, Harvard Business School, or McKinsey backgrounds. And they're more what I'll call like a raw entrepreneur, where there was like, they weren't incredibly crisp at articulating why that opportunity exists, what are like the drivers of that opportunity, and thus how they're going to maximize their sort of exploitation of that opportunity. And so traditional VC passed on them a lot, and that actually created the opportunity for me, because I wasn't at a traditional, I wasn't at a well-known fund. But what that has meant is that I really struggle to feel like I understand exactly how to underwrite individual founders. That has led us and me in my career to drift later and later and later, because the later the stage, the less the individual idiosyncrasies of the founder like matter in your underwriting. What matters a lot more is the traction, actual traction. Is the thing working? And so anyway, again, a little non-traditional there. We can't deal with a founder who's sort of deceitful or there's anything like that, but we don't have hard metrics on what we're looking for on founder. That's the other thing, because I've been part of a number of funds. Every VC, every single one says about every single founder they back is that founder is a great founder. I've never heard the alternative. And because I've never heard the alternative, I sort of don't buy that anyone knows what the hell they're doing if they're underwriting founders. I think they're just totally fooling themselves.
Everyone's baby is beautiful.
Yeah, taking it to the next level in terms of when you're looking at the team, though, are you looking at complementary skills? Are you looking at the chemistry of the team and their ability to pull everything off? What kinds of things are you looking at when you're thinking about team?
Are they working? Is it working? I mean, the benefit to us is in a traditional VC, you're getting a lot of inbound flow, and you're trying to assess among that inbound flow. That's not how we do it. We have a thesis, so we're proactively going out to finding them, and we're trying to find the absolute best version of that company. The primary way we do that is traction and performance, and then does the specific business model that they're going after give them the best shot of being the best and the best version of that model in that submarket. What that means is it's less it feels like it's less reading tea leaves, and it's more is our fundamental bet correct? Are we right on our thesis? If we're so anyway, I don't
I get what you're getting at. That makes sense. I fully follow what you're talking about, because you're not doing the more traditional route that people go by.
And then one other thing is teams change.
Yeah.
If you underwrote the team and you said, oh well, they don't really gel very well. If in 6 months the person who didn't gel well is gone, but you didn't do the investment 6 months ago, you were wrong to not have done that investment. So that even founders change. So I find it very, very difficult. I'm convinced that there are VCs. There are very, very good VCs who know how to do this. Meaning sort of intrinsic, like human underwriting of the founder, or the team. It's just not us. I just know that that's not where I have I don't have any special ability there. In fact, I probably have negative ability there.
Joseph posted a question in the chat. What stage do you typically invested in? What is your current thesis? That's something.
So stage, we've got a company that's hundreds of millions of revenue. We've got a different company that's very, very profitable. And we have 2 seed stage companies. So we are functionally stage agnostic. In reality, the vast majority of our capital goes in at Series B and beyond.
Wow.
So business is doing 7 million in revenue or north of ARR. That's both a function, even on a deal count, it won't look as that stark, but on a dollars, it'll look that stark, because we're allocating dollars on this, risk return metric, of which you get far more confidence in your answer if you're going later. The other thing is we're willing to wait a year or 2 years or a fund to make a play in a specific submarket that fits our thesis, because we don't want to be wrong. We don't want to pick the wrong horse. We'll have enough confidence in our ability to convince the founder that we're the right partner for them in the future. But we'd prefer to make sure we know which is we at least have a better, strong conviction on our side that we know which one is going to be that winner. On the what is the thesis? So macro level, we love businesses that control distribution in producer-led industries. Think of that. I'll give you 2 examples of that. Through our portfolio companies, there's a company called Place, which is in the real estate space. Place works with top performing residential real estate teams. And when we think about it from our perspective, not from Place thinks about this they sort of came at this problem in a different way. But when we think about Place, we think about these producers. So think producers like an agent, a broker, an advisor, human wholesaler. So in this case, it's the real estate agent. The problem that the real estate agent has in our mind is that not 100% of their time is spent revenue generating. Some 50-60% of their time is spent doing operational crap in the back office or the middle office of their agencies. And so what Place does is Place takes on 100% of the middle office, 100% of the back office of these top performing real estate teams, and helps those teams help grow the top line, all so that the team leader, the owner of the team, and the individual producers in that team can spend more time just selling homes, building relationships. That's the thing they should be paid for. So that's an example of our thesis. That's a business that controls distribution, meaning the sale of homes, in a producer-led industry. Residential real estate is a producer-led industry. Another example of this would be we invested in a company called HealthSherpa in the Affordable Care Act space, ACA, aka Obamacare. HealthSherpa is a marketplace that connects brokers who write ACA policies with the carriers who fulfill those, or effectively the brokers who sell those policies to the carriers, insurance carriers that write those policies. And so they control that distribution layer. That's what we love in a producer-led industry. ACA is broker sold industry. So anyway, those are manifestations of our thesis.
Thank you. Zarin has a question.
Yes, interesting. So with your connection with the insurance sector, people always talk about the Berkshire example where because they have the insurance arm, they have a longer horizon of investment and it's easier. So how, in your experience, relations with insurance sector impact investment or venture industry? Is it since they already, because they can wait, right? Like life insurance and all of these 30 years, 12 years, they don't need to get out in 4 years, the investors. So how does that impact the investment decision?
I could answer that question in like 30 seconds or like 45 minutes. I'll do some interim version of that. I forgot to mention that, I can't believe I forgot to mention this, but there's two sides of our fund. One is this very, very thesis-driven investing. The other is we have a massive proprietary network of insurance partners. We have 80 insurance institutions that the investing side of our house tries to see literally every single relevant insurance company, insurance startup in the world, because they try to process them, understand what they're doing, and then match them intelligently to the network, effectively the 80 insurance partners, purely so Viewpoint becomes like a hub connecting the startup ecosystem to the incumbent ecosystem. And all that accrues to us because we now have insane access to the industry. There's sort of nobody inside of insurance we can't get to, and that helps us because 60-70% of the capital we deploy is in insurance related startup of some kind. So that's why we are so connected there. Your question was about, also note that in Fund 1, a disproportionate amount of our capital came from the insurance industry. Huge percentage of it came from the insurance industry. In Fund 2, that it'll be more like 50-50 as we grow the size of the fund. In reality, your actual question was about, okay, like given the Berkshire model, like what's their approach to venture? It's really sort of complicated. There's a huge difference in liability asset matching between a life insurance and annuity company and a P&C company. So in Berkshire's case, Berkshire's backing Geico, but Geico doesn't have any of the assets. Geico's mission is to only hold the absolute minimum amount of money they can to ship everything back to Berkshire, and then Berkshire invests it. So it's a sort of you should be thinking not Geico, you should be thinking Berkshire, and Berkshire's not an insurance company. Geico is an insurance company they own, but that's not where the investments are coming from. They're coming from the holdco, which is Berkshire. In the US and in Europe, in fact, pretty much everywhere, the regulators of insurance companies have these rating systems of asset riskiness, effectively is the way to think about it. And the riskier the asset, the more the insurance company has to hold on their balance sheet as a reserve.
Like banks, yes.
Yeah. So in insurance, venture capital is equivalent to owning. So $1 they put in venture capital is equivalent to owning one individual equity security. So it's at the highest risk level. So it's a really expensive asset for them to own on their balance sheet. So they are judicious with it. Traditionally, insurance companies are really very relative to endowments, relative to family offices, relative to almost any other category. Insurance companies have the least exposure to venture. They tend to reserve their alt asset bucket to private credit or private equity, not venture capital. We'd like that to switch, but we don't have that ability.
Yeah, need to talk with the regulators. How to change the Basel ratings and make that whole.
Honestly, I don't think it's the wrong call though. Venture capital has underperformed dramatically. It's unbelievably illiquid. It has insane dispersion of returns by manager, meaning if you're allocating $1 into private equity versus venture capital, the quality of the manager that you're putting that dollar in matters far more in venture capital than it does in private equity. And so from a regulator's perspective, I think it's the right answer. it feels like the industry has dramatically underperformed its illiquidity requirements and its uncertainty requirements. And and even in the insane go-go days of 2020, 2021, you could get a comparable return by just holding, S&P 500 or whatever, Apple. And then now we're going through the hangover phase where the VC industry just like there's a lot that has to be yet to be marked down, and the VC industry is notoriously slow at doing that. So I think we're in for like a long, protracted period of sort of continued underperformance. The good news is now that the industry is sort of contracting, like from good news more for me than it is for startups. But good news is that like there's less capital available, and so that means that maybe returns will actually be good, just like the best venture capital vintages were 2012, 13, 14.
Yeah, but there are also some tools of financial engineering now. I think people, they don't want to go for lower valuation. Well, some do, but they create these structures or trying to sell economic upside rather than kind of value themselves down. But obviously it has come down.
Yeah.
Well, thank you.
We have a latecomer here. You're muted, but Nick, do you want to introduce yourself?
Yeah, sorry about that. I had a call today that was at 3. And I wanted to make it this morning, but I know that things had to change a little bit. So sorry about that, guys, for the interruption, but I wanted to see if I could catch something at the end. My name's Nick Matero. I'm with a company called Insperity. We provide full service HR solutions to small and mid-sized businesses, but been involved with some of the investment groups in Philadelphia and in New York, and really just wanted to get some insight and hear what you had to say, Drew, and just kind of stay up to date on what's going on in the market. So to be able to speak, about these things to my clients and to my prospects, and so hello to everybody.
Do you have a specific question you'd like to ask? I know you got here late, but
no, not at this point. Maybe I missed all the good stuff. Is this recorded? And
yes.
Will I be able
Yes.
I'll be able to go back and watch. So that'll be good. Maybe if I do have some specific questions, I could connect with you, Drew, and maybe reach out after. Okay.
I have a quick question, Drew. The way you described your fund and the types of companies you invest in, it sounds like you do more of, like a research and outreach approach versus fielding thousands of pitch decks. Is that correct? Or maybe you can talk a little bit about how that works.
We do field a ton of decks because we have this network side of our house where we're trying to see absolutely everything on the insurance world so we can be good partners to our insurance partners. But far more is we realize some startup is doing what we want to do. They control distribution in a producer-led industry, and then we typically off cycle go to the founder and say, here's what we do, here's what we can do for you. Sometimes it's taken us, one investment took us 2 years to convince the founder that we can help them in specific ways. I think it's both the combination of us being more convincing, showing our value rather than telling we have value, but also a component of it was timing more being right for them. So while we do that in general, the sort of deck processing, and we do that not randomly, we do it to be helpful to those founders, and so we can make great connections for them, is far less the way we source our deals.
Ian's got a question.
Yes, Ian.
Yeah, Drew. So you mentioned the drop in the availability of capital right now, but you also mentioned you just raised a new fund, 50% of which came from the insurance industry. So where did the rest of your limited partners come from?
I think I said a disproportionate amount came.
Oh, okay.
Next time will be 50-50. So, but you got to think that we finished the fundraise in 2023, first half of 23.
Right.
But the vast majority of that money was raised first half of 22.
Yeah.
Which which means that actually the vast majority was like intellectually raised before they signed on the dotted lines, the end of 21, early 22. My point is that it's like it's one of the reasons I don't believe any of the fundraising numbers that are set to years, because Viewpoint appears to have raised the fund in 23. We'd been deploying capital since January of 22. So anyway, I think we're actually we were like the last. There's a number of funds that raised when we raised because the same thing happened to them, which is that some partner had a great exit in 21 or 20 that led to whatever situation to allow them to go create a fund that took about somewhere between 1 year and 18 months. And so it's all hangover from 21. But that spigot shut down by January 22, February of 22.
Got it. And would you say the primary factor was interest rates in the drop in the availability?
It's more than that. That was the catalyst, but it wasn't the full factors. In my opinion, what happened is you had you got to go back to 08, 09, 30-40% of all VCs die, and you get this vintage of 2012, 13, 14 of actually really good companies. In the 2010 to 2014, you get Uber, Twilio, Airbnb, whatever. I'm missing a million, but there's very good vintages that come out of that era. In venture capital land, the early good vintages start showing good marks, and that causes the performance to appear to be really good. That, along with low interest rates, causes asset allocators to allocate a slightly more amount of money to VC than they did before. But that problem is venture capital is really small. Even a small increase in allocation from the asset allocator side swamps venture capital, and the total capital bumps. And because there weren't a comparable increase in number of good companies getting created, what you have is inflation of the pricing of those existing companies. And the inflation of pricing of good companies, of existing companies, leads to the appearance of outperformance, because we just keep marking up our book, we being the industry. And then so the increased markups of the book, the appearance of outperformance, leads to increases in allocations to the asset class, which causes more inflation in price, and it asymptotes in 2020, 2021. What happened in this whole time is, there's like a techno utopia. It's like, oh man, startups can do no wrong. Everything, the only way to get innovation is through startups. That starts like slowing down, and then the interest rates change we have these 11 hikes or 8 hikes, and so the spigot gets cut off, and then the whole card sort of drops. So it was a core component, but I believe it was a much bigger piece, is this appearance of outperformance caused by increased capital flows. And I have this other component, which I think that the LPs, right, the people we view GPs get our money from, I'm assuming that they no longer have a real concrete theory of where the value of venture comes from. They probably had one, and they were probably right on their theory from 2026 all the way through 2021. And now they're looking back at that performance, and they're like, oh, wait a minute, maybe that was all like market movement and not actual outperformance. So what does create outperformance in startup land? And I think they need to refigure that out. So I'm assuming capital flows into venture will be down for a long time. Now you're talking to someone who's more pessimistic on venture than the majority.
Well, yeah, I mean, you cited Uber as a kind of an example of a positive, candidate, but I mean, Uber has hardly ever been profitable, as I understand it. 1 or 2 quarters,
But they are currently worth $137 billion. They are currently worth $137 billion. So, no, they were a huge home run. They were the biggest of all home runs. They were, in sort of all respects, they're a monster. Can't believe it. I still get $137 billion.
Yeah, well, I think they are currently profitable. Who knows? Yeah. All right. Thank you.
John, do you have a question?
Yeah, thanks. I was listening to your risk profile and your thesis. It's and You're a niche within a tiny niche in the whole entrepreneur ecosystem. It sounds like your competition is actually the bank. So how do you create a value proposition to a business owner or a going concern that already has capital and assets and a good run rate? How do you convince them to go with you instead of just going to the bank?
The vast majority of the stuff we fund is not profitable. And if you're not profitable,
Oh.
you can't get lending.
Oh, I thought that was
And
your
so
thesis. Was that you had to have revenue and profits.
you have to have revenue. The vast majority of our stuff has revenue. I mean, we have a company that's doing 300 million of revenue, but
Okay.
not very profitable. So but we still have competition. Our competition is large growth equity funds or large venture capital funds. Lightspeed is a $30 billion venture capital fund, and they do very late stage stuff. So that would be we try to win on effectively two grounds. One is we think we know that founder's model, not that founder's business, but the business model that they're in. We should know that model better than any other investor in the world because it's the only thing we do. And so we should know other examples of their model and how that model has played out in alternative markets more than they know, because that's what we do and they don't do that, meaning the founder should presumably not know all these details about how these models have worked in other places. And presumably they really are interested in that. The other way we try to win is through our ability to sort of create value-added introductions in their space. Again, it all comes to our focus. That we are focused should allow us to be able to add more value than not more value, different value than a traditional VC. If I'm on a board where there's a great early stage, famous, high performing early stage New York fund, and the fund talks about how they have like a 1-to-3 ratio of investors in the fund to support to the portfolio staff. So it's overweight how much like firepower they can bring to an investment. They say, oh, we have all these experts in marketing, pricing. We can't do that. But they already have that on the cap table. So I'm not sure they need another one to do something similar. We say, no, we bring a different thing. We bring this incredible expertise and focus into this specific thing. The other thing that we do, actually, I should add this one other note of why we think we win, is our most recent investment was Spark. It's public, and because our fund size is public, you can do the back of the envelope on. I don't think we talk about how big our check is. Anyway, the upshot is
I was going to ask.
It's a huge check for us. That was a selling point for us to the founders to say, listen, we're all in with you. Like you're not getting me, you're getting the fund. There's 8 people in the fund, 2 other founders, 2 other partners. There's 3 partners all in. You get all of us, and it's hard. It's just a different value prop than what another VC would be pitching. Another VC would be pitching, oh, look at all this support staff we're going to give you, and stuff like that.
Thanks.
Yeah.
So you don't have a typical check size since you're investing at all levels.
2 to 20.
Okay.
Yeah. I'd say 20 is sort of our upper limit, and 2 is sort of our lower limit. It doesn't really make a ton of sense for us to do a check under that.
Okay. I wanted to give Ivan, who's muted right now, a chance to introduce himself. I know he got here late, but Ivan, did you want to introduce yourself and tell us a little bit about what you're working on? I guess maybe he's multitasking. Anyway, so next question. I work with this one fund where, they have offices all over the world, and they're saying that a lot more money is being invested out of Europe and Asia and the Middle East, and not much in the US. So, venture is not drying up. It just shifted a little bit.
Yeah, I could go with. Let me see if I have. I do quarterly letters and do annual letters, and in my most recent annual letter, I had a chart that showed a bit of the. Let me see. I'll pull it up. Hold on.
I'd love to see it.
Give me 1 second.
Even when I'm reading my daily strictly BC, I see a lot of money coming out of other countries, areas of the world besides the US. Yes, the US funds are in there too, but by and large.
I do spend a decent amount of my time on the road, internationally and domestically. Give me one more second. And I will
Okay,
find
sure, no
this.
problem. So are
Oh,
you
here
only
it is.
investing in US companies or are you looking for companies globally?
We look internationally, though. We say that at least, greater than 70% of our capital will be U.S. domestic. We have one German investment. In my prior life, I made a Indian investment that is exactly on the exact same thesis that's done really well in a company called Turtlemint. I guess this is not talking about the amount of money into venture. This is talking from LPs. This is more GPs to startups. But this is capital raised by U.S. startups 21, 22, 23.
Wow.
Round size changes by stage, gives Q3 23. Series D down rounds 21, 22, 23. This is we call this the hangover stage. And then I think all right, these are shutdowns of startups by year who use Carta. I do think that you would see a very, very comparable chart on decline of capital into the asset class globally. The asset class is and in the Middle East, I think almost every asset allocator out there will tell you is they are getting absolutely inundated with U.S. venture capital funds hoping to raise money out there, and I think that's I don't know, it's a weird dynamic.
Right. What was I going to say? I forgot.
These are all good questions.
Next question.
Well, just to follow up, I mean, has your firm looked at the Middle East as a source of capital?
We've contemplated it. We don't have any to date. Yeah.
Any reason for preference? I mean, I guess you would probably prefer to raise elsewhere, or what is your idea?
In my ideal world, we have a very diversified set of LPs. Right. I was thinking, even within the insurance space, it's really important for us to have a diversified set of insurance carrier industries. Property and casualty insurance in the United States is going through a hell of a time. Loss ratios are insane, and so insurance companies are losing money left and right. And in the P&C world, meaning think home and auto, right? Like no one can make money in home and auto. And so if all of our LPs were home and auto carriers, there's a good chance they can't fund us again. But interest rates going up really help the life and annuity carriers. So the ideal situation is our LP base is a diversified set of industries, geographies, interests, all like that.
Right. Okay.
So Amy had a question. Oh, go ahead.
Yeah, that's a good question.
No, she has another. What are your biggest fears as a VC? Good question, especially in this environment.
Fraud, founder fraud. That we back a company and it's front page Wall Street Journal X number, whatever, it's saying it doesn't exist. Like, I mean, think, what was it? Sam Blank?
Sam Bankman-Fried, yeah.
Oh man, that gives shivers down. I mean, most VCs. I mean, on the other hand, right? Like, some of this is like, okay, you probably could have done some basic diligence, but fraud by a ton. That's my that'd be my. Yeah, I think that's my biggest fear. Ryan, you have a question?
Hey, Drew.
Hey.
So I really appreciate this. I mean, the ability to see behind the curtain from a VC is phenomenal. And all the data points that you're telling me, I've been pulling out my hair, I've been sweating, and at least I know I'm not going nuts. So that's a good thing. And I really do appreciate it. two questions actually. Number one, is there any way we can have access to the data points that you just showed up on the screen, your letter or whatever? Because I think it was fascinating. Although I want to go in a corner and cry, but it's still good. And then the second question is from a startup. So, okay, this is the world. I have no issue with that. It goes back to the basics, which is sell stuff, right? Just sell stuff, get your traction, get out there, do whatever you got to do. And then raising money would be secondary. But if you still want to raise money, should you really just focus more on the seed? I don't want to say friends. Well, yeah, I guess friends and family, smaller checks and that kind of stuff. And just don't even worry about VCs, LPs, Series A, any of that stuff. If you're a startup, what are your thoughts?
I worried that there was an unbelievable amount of content written about like startup culture or how to build a startup from the 2026 to 2021 during that period. I'm making this up because I don't have any stats on this, but I assume like some ridiculous percentage of all startup content was written in that time. And I think it's probably all wrong now. And so you said back to the basics, and I think that is absolutely right. That I would not count on the venture capital world being anywhere like healthy again for a while.
Okay.
And but if it's okay to be a startup that's looking for venture capital, but you should know what it takes to raise. You need growth. You need cost-effective growth. You need unit economic positive growth. I mean, you can be burning money, but every widget you sell needs to make money.
Right.
Needs to. You need to be showing that the theory you have is working, and as many possible proof points as you can. And you need to assume you need your runway to last a lot longer than it lasted, than you would have thought 36 months ago. So it's still possible. Just know that the bar is much higher.
Well, it's always, I guess, I'm the old gray hair. I ain't the young buck. I'm a serial entrepreneur. I've got two successful exits. And, this one it's a mission for me, quite frankly. But it's always blown me away when you hear of companies, and there's companies in my genre right now in HTech that are, burnt through $25 million and still aren't at market yet. And they're using some fancy technology. And I'm like, it's got to be simple and effective. Get in the house and sell your shit. You got to sell shit, like plain and simple. And other companies that are very fancy, have very nice stuff, that are burning through 9 million a month, yet they're selling 4 million a month. And they're literally like, I just spoke to somebody the other day and he's like, this guy was like, in the malls when you walk past one of those fragrance things and the guy's trying to or girl's trying to grab you, like that's what he's trying to do. And I'm like, get away. And so I'm kind of overlaying what I'm hearing out there with what you're saying. And really, there's stress in the market. And as you said, in one of the plots, how many startups have now gone out, so I guess part of that thesis is if VCs have bet on founders and it's all about burning through stuff until you get to a point where you can sell and get a nickel back, they just don't have any runway. And they were all betting on getting another round of funding, their B, their C's or whatever. And then now they're going to be done.
That's the common wisdom right now in venture capital land about what's going to, it's already happened in 23, but 24 will continue. It'll continue for a while because, everyone did get the message in 22 that, okay, the party ended. And so people cut hard the startups cut hard in 22. It's just that if you don't have a business, if you don't make money, then you're gonna burn. And so, even if you cut, you sort of, that you can't outrun the fact that you're not profitable.
So the flip side of that is there's got to be opportunity. So in other words, if I have competitors that are going out, but that I could see that I could acquire or somehow partner or something, there could actually be opportunity there that they're burning up.
100%. I mean, can remember, hold on. Wish I knew the actual numbers of this. There's things called a secondaries fund, which are funds that buy out positions of other VCs.
Okay.
And the largest secondaries fund in history, I think, was just created, all with this concept in mind, that they're going to be. I mean, that's like the investors' version of what you're saying, but 100% correct that's going to be happening a lot this year.
Yeah, the opportunity there is for the VC or whoever is taking it over to turn it around, right, and build something successful.
Yeah, for pennies on the dollar,
right.
Or not turn it around, just absorb it. Presumably, it's sort of like there's some like entity that actually is working, and you could just like attach on all these like capabilities or components or clients, and you get to buy them all up for pennies on the dollar.
They've developed the tech, they developed the infrastructure. Now they just
There's I think this is sort of obvious, but there's a huge difference between where we are today and like what I understand was happening in 2001. In 2001, the ecosystem was didn't realize that they were totally correlated to each other. So that you had all these businesses where 100% of their business was to other startups. And so when the system came down, the whole system came down together. Everyone learned that lesson. So we're not in that situation. We are in a situation where we have a ton of funded startups, heavily funded startups, who don't actually have a business. And that's a slightly different issue.
But that was also the case in 2001. I was there. These people did not have a business model. It was all about eyeballs, and and I would meet with them and I would ask them, and they looked at me like this is what they would say: "You don't understand the new economy."
Yeah.
I love that one. I mean, I was just reading about Messenger. I'm sure everybody saw it, who raised $50 million and launched in May. How do you go through $50 million in under a year? Well, you pay your editor-in-chief $900,000. That's insanity.
You know the scooter company Bird?
Yes.
Right. It's gone. I think we don't do anything direct to consumer. One of the reasons we don't do anything direct to consumer is I can come up with virtually no companies, startups, created in the last 6 years or 7 years that is direct to consumer and non-gaming or entertainment related, meaning it's not gaming, gambling, or day trading that has a successful business today. Not a single one.
I think you just depressed half the people in this room.
I just want to follow up. Ryan had mentioned about the newsletters. Is it possible, Drew, that we can get access to your newsletters?
I didn't know I was going to be bringing it up in this conversation. I need to think about it because it's actually not widely distributed. But I can talk to Bonnie about it.
Okay, appreciate it.
If you want to send me the white paper, I'll only send it to the attendees here. If you'd like to do that. But
let me think about it. Yeah.
Okay. Yeah, no problem.
Thank you. Thanks.
Oh, there were a couple of questions. Amy wanted to know if you have any good book recommendations.
Oh, always. For sure. I love there's a woman named Andy Duke, who's a famous poker player turned author. Her book is Thinking in Bets. I think it's okay to criticize the book for being like maybe 70% too long, but the core point I love, which is you should be thinking in bets. That's sort of the point. Thinking in bets. Both Ben Horowitz's books are the best. Hold on. He has two of them. The Hard Thing About Hard Things is the best startup book ever written. And then What You Do Is Who You Are is the best book on culture I've ever written or ever read. I think there's a guy named Nassim Taleb who became famous because he invented Black Swan, the concept of the Black Swan. His book Fooled by Randomness changed the way I thought it changed my life when I was in high school, whatever. It totally changed how I think about everything. I don't think he's a particularly nice guy if you ever read an interview him, but he's really smart. And then I can do non-startup related books. But that's probably not that relevant. So those would be my startup relevant books or like business relevant books.
I'll second Thinking and Bets. It's a good read, and I agree. It's a little long, but you get the point.
Yeah.
What are the other two? I'm trying to take notes. So Thinking in Bets, and then what's the other one?
The hard thing about hard things.
The hard thing about hard things.
And what you do is who you are. And then fooled by randomness. I think those are the 4 I said.
The hard thing. Okay. I'm lost in the last one.
I'll give me 1 second. I'll just post
Yeah,
them.
put it in the chat. Yeah.
Sorry, these are Amazon links. They're not my links. I just Googled it. And then there it is.
Great. Thank you so much.
Thank you.
Yeah, thank you.
Oh, there was another question. Sorry, let me get back up to it. Oh, Janice, how is VC meeting DEI standards?
I don't know. I think I don't know. It was the question how?
Yes.
Meaning on like a procedural basis?
Yeah, is there a standard? As I have gone out to raise money, to Ryan's point about like raising from friends and family, and I do have that an enviable position of having inventory and all that with the consumer goods product. But if anybody has a head, neck, or back, you're my customer. So it's really a challenge to see, not being a standard. And I didn't know if that is anything part of the consideration. Like when you're looking at your suite of portfolios, I have a production company as well. And we look at, screenwriters and things like that might have a different viewpoint of life. So so that's part of our standard in cultivating films. So I don't, that became an internal metric that we have held ourselves to, that kind of standard. And I was just wondering, do you have an internal, or is this in the VC world, is this a conversation between other funds?
It's definitely a conversation. It was far more pronounced conversation in 2020, 2021. It has been dramatically scaled back as I feel it. From Viewpoint's perspective, our mission is to come up with the most correct, most true set of theses. And to do that, you need diverse sets of opinions. And so that's like core to the route to get to deeper truth. But it's but I don't know if I think the industry is pushing hard on it a couple years ago, and then more recently I've noticed how it's far less prominent.
Yep.
Thank you.
We always want to bring in the best people. One would think. Next question? Or comment?
I do have a question. In terms of the, I know that I was just recently in the JP Morgan Investment Week, right? And it seems like there's a lot of sentiment that right now, advice for startups holding back of raising because it's not really the best time for a startup to raise. And what are your projection of like, when do you think might be a good time for startup to consider raising?
I think we will never be back to 2020, 2021.
Yeah.
Never. I think for us to be back to 2019, you should be thinking 2030. For us to be back to 2016, I think like 2026. So like I think this will be pronounced. However, the right time to raise is when you have the right metrics to raise. You can raise money today. I'm being very pessimistic, I guess, but I think realistic. But it's not to say there's no deals happening. We're looking at a deal right now that is very competitive, because effectively what's happened is every VC has shrank their buy box. What they're interested in has all moved, and it turns out that when you actually put pressure on VCs to make money, they all shrink their buy boxes in exactly the same way. They all know what good looks like in a business. And so what that means is for those few businesses that have good metrics, it's 2020 pricing, 2021 pricing. Seriously, it's like, very, very attractive pricing. It's just that there's that narrow group that gets a lot, and then there's a desert of challenge. That presumably that desert challenge will get easier in 2025, is my guess. It'll get a little bit better this year, particularly if you're early stage and stuff. Yeah, that's what I think.
I would like to comment here, and I wrote recently about 23andMe got hacked again, and their valuation went from they were
zero.
Yeah, they're $6 billion company to zero. Well, who's the founder of 23andMe, which a lot of these articles never mention? Sergey Brin's ex-wife.
Yeah.
So it was that whole, and then her sister became the CEO of YouTube. So there was this whole Silicon Valley, throwing money at whatever, and it was very insular. Gee, I wonder what happened. Why valuations are down? Why these companies? I know I wrote about in the newsletter that they're blaming the companies, the users on the hack. It was just. Go ahead. I'm sorry.
No, sorry. I didn't mean to cut you off. I'm sorry.
Oh, no. It's just, throwing money at their friends and not looking at business models. I've been involved in this industry for a long time. And yes, I know it's a downtime in the industry, and I still work with founders, and I tend to introduce them to potential partners who can bring in revenue. And, now it's been a year, it's been 2 years. Some of those partners, which are very large companies, then they have investment. They're doing the investing. Partners.
Yeah. The one of the things I think would be an interesting, challenging dynamic for the space is some very high percentage of all angel checks in the entire venture capital community came out of very well compensated tech employees at the top tech firms in the Valley. And all of that is gone. Google is shedding staff, cutting budgets, and that will be really tough, because the VCs, there are not a lot of VCs that play in that angel check land, and that is so. I think that's like a pretty unfortunate thing for the industry. It was a really vibrant way to create a lot of companies, and I think that'll be a really big challenge.
Absolutely.
I have a follow-up question, following what
Yeah.
Bonnie. Like for me, we are more interested in an investor who actually can help us get to the next step of, sustainable business models, and more like, can you help us get customers versus you just give me the money. I don't want money. I want revenue. That if you could help me get there. And healthcare, obviously, it's a slow pathway, right? Like, can you secure me insurance company for pilot partners? Can you help me get into reimbursements? Can you help me secure government contracts? These kind of things I'm more interested. Like, how do I identify the right investor had these kind of ability to help company move forward instead of just giving us money?
You in your first conversation, you'll know if they know what they're talking about their industry. And so that is my primary recommendation, is you talk to them and you're going to have a feel of whether they actually understand what you're talking about in your space. I would caution you to look to your investors to drive your business. We don't do that.
Okay.
We can, and I'm saying we meaning the system. I don't care what they tell you. They don't do that. They might be able to tee up some options. They might be able to tap their network. They will not build your business. They will. It is unbelievably unlikely that they give you that one client that doubles your revenue. Your business, and they will not invest if they think they need to do that. The only route to capital is that they believe you're going to get there anyway. And so of course they should be along for the ride. It's sort of like, this is different, but it's sort of like I talk about, I've never seen an enterprise software business or small business software, anyway, anyone selling B2B software, successfully hire a salesperson if the business is doing under the 10 million of revenue. I have never seen it. You can get salespeople who are not good, but they're good at selling themselves, but they're not good at actually delivering the product. But they are good at selling themselves. So you hire them, doesn't work out, and you fire them. And I've seen that so many times, and I've literally never seen it. And the reason I'm bringing this up is because good salespeople, I'm going to make the equivalent like good venture investors, they don't want to work with a company that's going to be hard to sell. Good salespeople want to work with businesses that have very high ACVs, so they make a lot per sale, and the sale is really easy. The brand already exists. The product is fantastic. They already have all this marketing collateral that answers all the questions. Those companies get the best salespeople. And the worse you are at all that, the worse salesperson you get. It's the same thing on capital. That, you know, if you need them to do the thing, you're probably going to get someone who's not very good. They'll promise you a lot, for sure. They will. But
Yeah, that's a really good insight. I appreciate that. And like, what if you just like say open up the doors? Like, you know, they don't necessarily help you sell,
yeah,
but open up the doors, like introductions and stuff.
they should be able to do that. Like well, I'll tell you how we do it. Because I mean, if somebody should be good at this, we should be good at this because we have this. I mean, we built a freaking network. We dedicate half the fund's team resources, to building this network and servicing the network. So we should be like decent at this. We don't promise anybody anything because we don't control outcomes, and because we don't control outcomes, so we don't sell on access to the network. We sell on our expertise. We'll work. Well, I mean, we're now massively incentivized to help you in any way we possibly can. I mean, literally, our money's on the line. So, we can't. We train the team. You cannot sell that we will give you access or we will get you introductions because we literally don't control it. What we will do is say, we're gonna ping our network, be like, hey, you're interested in meeting with these people. We always do double opt-in intros and all like that. So anyway, just they should be the good ones. Anyone who understands your business, there's no way they don't have connections in the space. They wouldn't have been able to understand the business unless they had connections. And in fact, the more they understand it, I think this is probably true, I'm making up right now. The better they understand the space, the more likely they have high quality senior introductions. Because senior executives in industries want to talk to super smart investors who see different things from them. And they don't want to talk to dumb investors. So like that's the other thing. Like, it's not like, oh, I have XYZ names. It's really like, no, they have close relationships with a couple important people, and then they're going to try.
Yeah, and I guess a follow-up question would be like, say for startups, when we looking into potential investors, should we only consider the company that only focus on healthcare industry, or like more having a diverse industry portfolio? Because I have experience with Accelerator that I gone to a couple of different ones, and I noticed the difference that the one that is healthcare focused versus like all different industries. So I'm curious in terms of like,
I would tell you can't generalize like that, meaning it's highly firm to firm specific, and who the partner is that's sponsoring you. Do you get along well with that partner? Do you respect him? Are they smart? Are they interesting? Do they follow through? Do they have good relationships? If you're in the enviable position to be able to choose who your capital provider is, one, you like win. Like you're already right there. You're like, you're in a really good spot. But okay, let's assume you're in that spot. What I would do, I really would talk to as many founders of theirs as I could. And you want to understand the firm and you want to understand the individual. And in general, I would say the individual matters a lot more than the firm. In general. But so I'd be talking, and I would be talking to more founders. Like you're entering a marriage with this capital provider. You're with them forever. And so it makes sense to like try to really understand who they are and the best ways, the founders, and not necessarily the founders that they introduce to you. Obviously, like they're going to send you their best founders. You should try to talk to 3 or 4 others.
Okay. Yeah, so it's kind of like due diligence check from the founder side, right? Yeah. Okay.
Yeah, and and it's less like what they say on paper. You know, this is an industry focused fund. It's more, are they giving you insights you haven't heard before about your business, or do you feel like they actually get it? They actually get it.
Yep. Great. Thank you. Love it.
And always good to keep your investors in the loop, you know, send them updates. A lot of founders
That's true.
A lot of founders forget that. And if you haven't asked, ask. You don't get if you don't ask.
Yeah, I've been told on that one too. Yes, that's a good advice for a lot of founder. Like even like say for us right now, we're not raising outside funding, but we've been told to kind of build relationships. So when we do need outside funding, then you know you can more like people already get to know you and maybe even advise you in some capacity. You know, could be a kind of that dating phase, right? Just like you say, you don't want to get into a marriage without date first, yeah.
So we just have a couple minutes left. Is there one more question, or Drew, do you want to share any parting advice?
I can't think of anything that's, I haven't already sort of mentioned. And yeah, probably no.
But I do want to remind everybody that it's in down markets that some of the most successful companies emerge.
That's historically very true.
Yeah.
That there's something about the whole like scarcity breeds quality thing that it appears to be very real. Where it's just like, it's just too easy in the good times to waste a ton of money on the wrong path. Versus these are the markets where it's like, no. Like, every marginal dollar, like, is that the right place to spend? Is it the wrong place to spend it? Yeah.
And the smart companies don't stop marketing. They keep pushing.
They keep
totally agree.
There's that fire in the belly that distinguishes the winners from the losers. They just don't give up. They'll pivot. Everybody pivots, but they find that niche and they just pursue it. Thank you so much, Drew. I'm glad to hear you.
Thanks for having me.
Doing better.
Yeah.
Thank you, everybody, for being here. And apologies for the changing time, but all works out in the end. Then have a wonderful 2 weeks.
Thanks all.
Thanks, Drew. Great discussion.
Thanks.